Great. We're super excited to get everyone started. It's my pleasure to welcome you now to the unit economics of cooking solutions, understanding critical cost drivers for clean cooking business models. This is going to be a two-part session. We're going to start with a presentation by Ed Day, who is the director of Greencroft Economics, and then we'll be following that with a panel. So Ed, can I ask you to come to the stage?
Thank you, Lindsay, for the introduction. So I'm going to start off with a relatively short presentation because I'm aware that our panel live and breathe this stuff far more than I do. But this is in the context of a new piece of work that we're just kicking off with the Clean Cooking Alliance to sort of investigate and try to develop a standardized framework for both the unit economics of the clean cooking sector, and I'd say that's both the critical cost drivers but also on the revenue side. And so essentially, can we develop a common language and methodology around talking about unit economics that works for investors, for companies, for new entrants into the sector as well. So I'm just going to go through three very quick sections to provide a little bit of context for our work and hopefully give a bit of background to the discussion that the panel is going to follow on from as well. So what do we mean by unit economics? And I've had a few conversations in the corridors this week, which either boils down to it's all incredibly simple, it's just two words, or it's sort of overwhelmingly complex and there's so much that goes into it that how could you possibly try to standardize this? And I think the truth is probably a little bit of both. Just to be clear, when we're talking about a unit, it's mostly focused on a unit of outputs or a product. That could be either a stove or a unit of fuel or a combination of both. But we're also interested in how that product goes through the clean cooking value chain and what the sort of cost centers and cost drivers are throughout that product journey to get it to the end user market. So we're also interested in sort of operational business units as well as the product unit in itself. And when we're talking about economics, that really is about how the costs and revenues associated with that unit evolve as a clean cooking company scales and reaches maturity. So in particular, we want to explore and try and work out where are there opportunities for economies of scale on the cost side, where might there be diseconomies of scale and costs go up as clean cooking companies start to grow and mature, and equally, what are the opportunities for revenue generation at different points in that company journey. I'm not going to go through this slide very much, but the unit economics could mean lots of things to different stakeholders. It's not intended to be a one-size-fits-all type of approach, but we're hoping that the toolkit we develop over the next 4 to 5 months is something that could be useful for investors, companies that are mature and at the beginning of their journey, wider stakeholders alike. But the essential is, I guess, the bottom bullet. We're aiming for something that standardizes the language and the conversation around unit economics so that in kind of the same way that there's been lots of progress on the impact side of the clean cooking sector and a much greater understanding of the impacts that clean cooking businesses deliver and what they might be worth, I guess we want to try and achieve the same sort of progress on the economic side to provide a somewhat simple, standardized process for talking about the costs and revenues of clean cooking businesses of different types. Okay, and the simple bit of unit economics is it really boils down to what are the costs on the one hand of the equation and what are the revenues on the other side. I'm not going to go into those in too much detail because they're both fantastically complex, but I will say that obviously there's been some really significant game changers, particularly on the revenue side with clean cooking businesses. You can no longer talk about clean cooking and only talk about the sale of cook stoves and fuels. You've also got to talk about the potential for sale of carbon credits and revenue generation from carbon markets. But also we're seeing some really innovative approaches to monetizing other outcomes such as health and gender-related outcomes, which also can provide revenue streams for cooking businesses. And I guess the bottom row on the top of that graph, once you've taken into account the balancing act of different costs and different revenues at different points in time, we want to get to an understanding of what does it take to, for different clean cooking businesses to become commercially sustainable and profitable, so to ideally provide a profit margin that can be reinvested in the business and can provide a rate of return to investors. And that's going to be key to scaling up finance to the extent that the sector needs. Profit shouldn't be an ugly word for clean cooking businesses. If we want commercial investors to be excited about coming into the sector, we need to start understanding where there is potential for margins to be made. On the other hand, on the other side of the equation, we also need to recognise that particularly the timing of costs and revenues and their nature, come at different times for clean cooking businesses, and it can take many years to achieve commercial sustainability. And so using a sort of unit economic lens, what is the role of catalytic finance that helps overcome fundamental barriers in unit economics, and how can that be used as a short-term instrument to catalyse growth in clean cooking businesses? But also, what's the potential long-term viability gap if we're talking about expanding access to clean cooking technologies and higher tier technologies to households in rural areas across sub-Saharan Africa? I think we also have to acknowledge that there's likely to be a gap between ability to pay and the cost of some of those higher tier technologies. And there we're using the unit economics framework to understand what the long-term subsidy requirement might be in those contexts. All right, I'm going to go really quickly through these slides because these are summaries of evidence that's already out there. Unit economics is obviously not unique to the clean cooking sector, but there's lots about the clean cooking sector that is unique to unit economics. In particular, the cost of delivering different types of technologies to households varies very significantly by technology type, but also by the business models used, by the maturity of the businesses involved, and also the structure of those costs changes very significantly across technology types and across the company journey. So different technologies have different amounts of costs sort of buried in the provision of the stove versus the long-term continuous acquisition of fuel, etc. So on the cost side, there's lots to think about. The revenue side equally has its own complexities and nuances for the clean cooking sector. And in particular, I don't think we can go through any of the sessions at this conference without talking about carbon credits and how much that might be worth. This is from the Clean Cooking Alliance industry snapshots, which shows broadly revenues stayed roughly constant between 2017 and 2020 for clean cooking companies. What changed drastically was the amount of that revenue coming from the sale of carbon credits. And that clearly makes the unit economics of clean cooking businesses very different today than it was 4 years ago, and also continuously evolving in a very dynamic context of that potential revenue generation. And 11 million sounds like a lot compared to where it was 4 years ago, but the potential for carbon markets is presumably much bigger than that 11 million if we can get the right approaches. I'm going to skip that one. So just to round off, I hope that context was partly familiar and partly new and interesting. Our work is going to be running over the next 4 months to try to develop a framework to feed through from a number of clean cooking archetypes representing different stove and fuel combinations and different business models, to then interrogate what the key cost drivers are for each of those different types of clean cooking ventures, what the revenue potential is at different stages in the company journey for different technologies, and also to try to capture what regional and contextual factors drive both differences in costs, but also in revenues for different types of ventures. So that's a lot for us to try to get into a single framework, and that's why we're going to give ourselves a few months to do it. We're at a very early stage in our journey. We're just in the sort of design of the framework that I've just put up on the slide before and fleshing that out to make it comprehensive. I will finish by saying lots of you in this room are likely to be hearing from us in the coming months, in that we are going to want to go through an exercise of interviewing as many practitioners as possible to get your insights into what matters in terms of unit economics, and also rolling out some company surveys to make sure that what we develop is based on the realities facing cooking businesses on the ground in terms of what it costs at different stages in the value chain to deliver technologies to customers. So if all goes according to our plan, we're hoping to launch in early 2023, and we'll be very grateful for sort of your help and insights between now and then. So I think that's it from me, and I'll hand back to Lindsay to introduce the next section.
Thanks, Ed. I just really want to emphasize that last point from Ed about us really needing our community participation in this exercise, and we're only as good as the data that we get and the data we're able to analyze as part of this exercise. So please feel free to find Ed or to find me if you're interested in hearing more about this work or finding ways that you can contribute to the data that we're collecting. It's now my great pleasure to welcome up Dr. Susan Strycka, who is a Senior Research Associate for the MEX program at Loughborough University. Her work is focusing on the evaluation of RBF programming, impact funding, including carbon finance, and the integration of electric cooking in the on- and off-grid energy sectors. And she'll be joining us as the moderator for this session.
Thank you very much, Lindsay. Thank you everyone for being here with us, discussing this very important issue of unit economics. And I'm really, really glad we have a fantastic panel. So I'm welcoming Ada Marmion, who is the Director of Partnerships, Knowledge and Impact at the Africa Enterprise Challenge Fund, AECF. Hi Ada, good to see you again. I'm also really thrilled to see Rocio Ochoa, who is the co-founder and director of Bida Sasa. Hello, Rocio. And we're also welcoming Farai Siseko, who is the executive director and fund lead in the Africa Go Green Fund at Lions Head Global Partners. Hi, Farai. And last but not least, I'm also happy to welcome Vincent Bierda, who has the energy lead of UNCDF's program for Inclusive Digital Economies, IDE. Thank you, everyone. And before we dive right into the discussion of unit economics, which is a very broad area, I would like to introduce our panelists to give a short introduction and explain a little bit about your role and relation to unit economics as a topic itself. 2 to 3 minutes.
Not really. Now it's better? Yeah. Great. So thank you so much, Suzanne. So AECF is a non-profit fund manager that has been operating since over 12 years, focusing on building resilience by investing in SMEs that serves the rural, marginalized communities with products and services in the renewable energy, climate adaptation, and agricultural sectors. To date, we have invested in about 375 companies that have created over 25,000 direct jobs. We have deployed over $440 million and leveraged over $770 million in match funding from our investees. So for every dollar that AECF has invested, our investee companies have managed to leverage ×4 of our money. They have impacted with their products and services over 30 million customers in 18 countries. Our focus on clean cooking is strong, but clean cooking is still a small part of our investments. We have invested over $12 million in the last 8 years in the sector across 28 companies. So I'm guessing most of you are really good in mental math and can very quickly see that it's only about 2% of our overall investments, and it's gone very fragmented, smaller ticket sizes, very much spread across larger international companies and local ones. We are trying to find the balance here between impact and depth of impact. Our companies are across 9 countries in East, West, and Southern Africa, so that also gives us an understanding of the different challenges of the different markets and technologies in different parts of the continent. Our investees have reached 100,000 households with their products and created over 800 jobs, so definitely clean cooking investments create jobs locally. And because we want to do our share in increasing the amount of capital that goes to the sector, we are now launching national focused funds, clean cooking funds, and we've launched one a couple of weeks ago in Tanzania. Our fund manager, Frederick Tunutu, is here with us, and we are accepting applications. So if you're a company distributing your products and services in Tanzania, looking to scale, looking for investments, please go and speak to Frederick. I think we are accepting application until the 10th of November.
Thank you, Ada. Lovely sales pitch. Thank you so much. Rocio, would you say a little bit about your company for those who don't know what you're doing, but assume that's very few?
Yeah, probably you don't know. But anyway, I'm not as famous as the AECF, so. I run a company called Bida Sasa, which means products now in Swahili. And what we do is we are last mile distribution and finance company. What does that mean in practice? It does mean that we are targeting specifically rural women's needs, which means that they need lots of things. It's not just about cooking. So obviously, we are providing access to clean cooking devices of all type of fuels. So we are very much product agnostic, but that's not the only thing that rural women need, at least in Western Kenya. So we are also doing agricultural equipment, water-related products, and a little bit of solar products. And we do, so two things that maybe are slightly different from other businesses that you've seen out there is that we are product agnostic, we sell multiple products, and that it impacts on the unit economics conversation. And also the fact that everything that we sell on credit. Again, it will impact on the unit economics discussion later.
Thank you very much, Rosio. Let's move over to Farai. Farai, maybe you can introduce yourself a little bit and your work you're doing in the investment sector.
Sure, thank you for having us. So I lead a relatively new fund in the sector called Africa Go Green, whose mandate is to invest in projects and businesses that reduce carbon emissions or improve energy efficiency. We look at a range of sectors, one of them being clean cooking. And our interest in clean cooking is primarily because of the impact it has on the reduction of emissions, but also on the improvement of quality of life of people on the continent. Now, we focus primarily on the African continent, and we provide credit, or that is debt, either senior or mezzanine type debt. And we've already invested in the clean cooking space. We're agnostic as to the fuel that is used, so we've done LPG for cooking already. We're looking to invest in businesses that are also producing more efficient cook stoves. And we are really hoping to help move the agenda of clean cooking by providing debt financing, which we feel has been limited in the clean cooking space for various amounts of reasons. And I hope to explain as part of this panel what we look at, what we consider in unit economics, and how we sort of push the envelope in terms of provision of sufficient capital to grow this space. Thank you.
Thank you very much, Fry. And finally, Vincent, for those who have not seen you on the stage yesterday, could you briefly introduce you and your work, and maybe also touch a little bit on the question why unit economics is such an important topic for a huge UN agency like UNCDF?
Hello. Yes, thank you very much. So I work for the UN Capital Development Fund, which is a UN agency that is able and does work directly with the private sector. And in our case, we provide catalytic funding for energy service companies in very challenging last mile markets. And have done so in a number of energy fields, so off-grid solar and clean cooking being two of the key ones in some very difficult or emerging markets, I should say, including Ethiopia, Uganda, DRC, Burkina Faso, and in near future in Madagascar, Malawi. We have invested both grant, let's say, patient upfront capital in companies, but also have done some guarantee and loans, very, very small ticket in a very limited number of companies, again, to show some catalytic or some example that we hope can attract others and crowd in finance, both international, but also especially local bank finance to skill models. So we've worked with 80 energy service companies in different places. The interest for us is that we see, and there's a strong parallel, I think, when you look at the solar, decentralized solar industry, there's an initiative called Pay-Go Perform, which we are part of also with the IFC, the Global Off-Grid Lighting Association, and several DFIs. And really the aim of Pay-Go Perform is to look at common performance metrics or indicators for the sector, be it financial, operational, also unit economics, that can sort of bridge the language gap between those who are actually the companies on the ground delivering the service, and the finance that is looking for investment opportunities, but their interface sometimes is lacking a bit. So this is what we try to promote.
Thank you, Vincent. And you touched a little bit on PayGo, and this is part of like the big landscape transition we have seen in the clean cooking sector over the last years, and we've seen that evolving from ICS to more higher tier, higher technology devices. The business models are changing. So, Vincent, from your perspective, and especially with your view on digitalization, what has changed in terms of unit economics over the last decade or so, and how does that impact future business models and unit economics?
It's a very broad question, and I certainly don't have all the answers. So I'll just give me some observations. One, I think, is that the technology has pushed along, and that when you look at the devices, it really is a discussion now where we move from ICS to more modern energy cooking solutions. That's being pushed very hard, and I think that's quite interesting because it enables all kinds of new things to be measured, and also I think to move towards a more standard approach of talking about markets. I think also, I mean, as was presented earlier, carbon finance and climate finance, if you like it, is a broad category. It has tremendous potential to scale even much more, and there's an encouraging start, but I think it is a big trend that will come. There are several big players in the sector. I don't think there are enough big players, but at least there are some that can tell us something about unit economics at scale, which I think is very important. And lastly, you also touched on that, is there's all these digital means by which we can now do much more on consumer financing. We can measure use case much more accurately. We can do much more on MRV to make that cost effective and reduce the field survey cost element of that. And I think importantly, coming back to the client again, digital enables us to learn much more on the demand side of the market, which I think sometimes we obsess a lot about the supply side of our solutions, but it's really important to, I think, understand the demand side. And so I think all these things have a tremendous potential, and where unit economics, I think, can really come in very strongly. That said, I think unit economics, I mean, still has big challenges. You have the prototypes are so many, it's difficult to generalize. I think it's easier maybe to do, for example, an off-grid solar, but we should still try. And the other things are that I've heard come up in sessions over and again is, the affordability gap, how we address certain client segments, and these things also, as we talk more about unit economics and RBF indeed, I think are still very much up for discussion and debate. But I don't have a very binary view on this. I think the space is still very wide, and we should welcome all kinds of opportunities to grow the market over.
Thank you, Vincent. And I think we will touch on the digitalization and user monitoring a little bit later when we talk about carbon finance in the context of unit economics. But for now, Rocio, Ed has presented the balance of unit economics, or the imbalance of unit economics, from your perspective as a distribution and finance company in Kenya and Uganda. Can you explain a little bit of what the cost and income structure look like for your type of business?
Yeah, I did like your slide with the pluses and minuses. The way I look at it is a ratio, right? And pluses and minuses. And why the ratio? Because what matters really when you're looking at unit economics is what happens at the margin. It's not about the raw amount or the absolute number of how much it costs to employ people. It's how much it costs to employ the next person, or how much it costs me, or in the cost of goods sold, which is my main cost. How much can I reduce my cost of goods sold if my volumes go up? So it's always about the margin. So I always look at that. I don't look it into columns, I look at one on top of the other. So we are a distribution company, so my main cost, by definition, pretty obvious, is the inventory, is the cost of goods sold. Everything else is pretty irrelevant, including the IT, including personnel. And this is shocking, right? But it's true. All the money I have goes to inventory, and everything else is irrelevant. Why is inventory so important? It's because that's what we do. It's the core activity, economic activity, which means that what we need is a scale. The more I grow, the more my suppliers will grow together with me, and everybody will benefit from bigger volumes, lower prices. And I think if there's one message, we live and die by the prices that we can negotiate with our suppliers.
Thank you. And if you say scaling, I mean, there are certain barriers to scaling, and we have hidden costs that might not show up on your P&L.
Yeah.
So can you maybe refer a little bit?
So there's a lot of hidden costs that they are not necessarily easily displayed in a PowerPoint. And maybe I'm suggesting a new terminology for it. I just made up as you were speaking, impact premium or impact risk. As you know, why? Why do I say that? Because if I'm a robot and I want to maximize my revenue and minimize my cost, right? I wouldn't be doing stoves probably, especially not in rural areas with low-income rural women. I would be doing something like selling televisions in Nairobi city, or something more profitable and instantaneous. So I think the impact premium or the impact risk is never really discussed openly. Tangentially, today there was a lady talking about climate bonds linked to co-benefits and some of these, how do they call them? Fancy carbon credits, or what do you call it? Charismatic carbon credits with gender, or I don't know, whatever, or the additional benefits. I think on the other side of the balance, we have extra risks that I'm taking on a daily basis. I'm reaching low-income rural women in places hard to reach, and I'm doing many jobs. I'm a financier, I'm an logistics company, I'm an IT company, and all these things because the infrastructure doesn't exist. The ecosystem is not well developed. So I think those hidden costs, they don't show up in my P&L, right? And vice versa. The revenue that I get from my revenue is simply what my clients pay. It's very simple. The revenue doesn't show that extra risk that we take either.
Thank you, Rothio. That's very interesting perspective. And Ada, Rothio has mentioned last mile distribution, which is core to the business and definitely a big challenge. But we also want to think a bit forward in this session to see how can we enable scaling up and what are the issues. Rothio mentioned the inventory costs, which are playing a big role. So from your point of view, Ada, how could bundling or investment in insurance for goods in transit and warehousing help to reduce these costs and bring down prices, increase revenue, and help to scale up?
Yes, thank you, Suzanne. I think it's really for us investors to be a bit smarter at where do we invest our money to unlock things for the distributors, the manufacturers. And so it might not always be that we'll have the biggest impact with our dollars in one company that is manufacturing stoves, but rather in enabling companies on the logistic transports, curating insurance products for good in transit, for local transport, or for cross-border transport, bundling of imports. Like we see now in our portfolio, a lot of our investee companies are struggling because the prices of metal sheets that they import from Russia, for instance, has gone up ×4. So basically, it's no longer viable for them to produce. It's the end of the story, So like, as investors, can't we think of doing bundle procurement, of stocking for those key components that we know are very vulnerable to price fluctuations? can we think of investing in innovative warehousing structures in the last mile that could be good storage points for the distributors, safe. There is a lot of stove are very heavy, yeah? They break, and transport, they break if they are not properly handled. Can we invest in IT technologies that help a taxonomy for clean cooking products and stoves at import gates, you know, to help the custom authorities to process better if there is a tax rebate scheme? Because it's not enough to have a tax rebate scheme. Then, you know, the man in the room who's receiving those products at Mombasa port, he doesn't know what is what. And you hear of companies saying, I've had 6 different rates to pay, depending on who was there that day or what time of the month it was. So I think there is a lot of work to do on these enablers, investing in that. In the green mini-grid space, there is this innovative testing facility for bundling and procuring of goods attached to RVF schemes. So in Nigeria, you have an RVF scheme for green mini-grids. And so we know already about the volume of mini-grids that are going to be invested in. And so this procurement bundling platform is procuring meters, inverters. Those are going to be key components of all those mini-grids regardless of where they are. So could we think of something a bit like that as well, and to invest in enablers that can have a big impact? And for instance, I was talking with one of our investee company in Mali, and he was like, okay, you know, we need, our biggest challenge is to source ethanol in a low price and consistently. But then if we want to have a good price, we need to buy a lot of stock. Where do we store it? Where can we store a lot of ethanol that won't go bad, that won't be spoiled? How much is that going to increase our cost, our unit economics? So is it for governments to build the infrastructure for storage of clean cooking fuel? Also, like in one of our companies in Ethiopia during the COVID time, had a big challenge because all of a sudden all their supply and contracts for ethanol sourcing went dead because the government prioritized the use of ethanol to produce sanitizers. So these are very big political risks as well on how priority can shift when you have locally sourced fuels. It's much more resilient to the ups and downs of international market prices, but it is more vulnerable to local policies and prioritization of fuel use. And also, ethanol get better prices if it is sold to the food and beverage industry than if it is sold to the clean cooking industry. So how do we also help incentivize fuel producers by, you know, also awarding or rewarding them for selling their fuel where the impact will be higher?
Impact premium.
Impact premiums and yeah.
You were nodding, Rocio, so I suppose this is a good match in terms of exchanging ideas and approaches. Maybe we can touch on that a little bit later. Thanks, Ada. Thanks so much. Moving a little bit away from the distribution itself, I'm looking at the business model and stage of growth of the company. Max and E4I have recently published our landscape report where we illustrated the S-curve of a business growth with many clean cooking companies. So you reach a certain peak, but then you're unable to scale. And RBF usually tries to tap in for companies at a more mature stage instead of, you know, providing like innovation funding. So I would be really interested in the stage of business AGG would invest in, and what are your considerations with this regard to help scaling?
Sure, thank you for that. So we would look typically at businesses that are sort of reaching that inflection point where they're about to grow. So it's probably early growth, mid-stage growth, or late growth before they get into maturity. And the reason we do that is primarily because we need to have some visibility or understanding of the ability to generate cash flows into the future. Now, you asked what we look at, some of the key criteria we look at when we're looking at these businesses at that stage. Firstly, it's about the product or the technology, right? Is this product something that has been market tested? You know, is there sufficient demand? Is it consumer fit? Is it fit for the consumer? and is it sustainable into the long term? In addition to that, we then look at the supply chain issues, which is something we've just touched on. How easy is it to get the product to the market, but also how easy is it to get the inputs, for that product to be viable to the customer. The second thing we look at, because I look at product and supply chain as one, is really the team that's working in these businesses, right? What experience have they had, and have they cut their teeth in the sector? And this is a team that we can count on to deliver, the growth and be able to respond to the market as things change. And as you know, the clean cooking space is still very nascent, so it needs a management team that's dynamic, that is quick to think on their feet, and can solve problems as they arise. I think also capitalization and shareholders are an important factor for us. I think once businesses have got to that growth stage, typically they have a shareholder base that is one we can count on as a lender. Because you need to remember, we're a lender, we're not an equity investor. And so having comfort around the people that are, or the funds that are supporting these businesses is important. If things go bad, are they able to step in? Can they capitalize the business efficiently? And then finally, two really key important things is, like I said, visibility of cash flow generation. And this then goes down to your unit economics, right? Can we see the business in the next 2 years or 3 years being able to generate cash flow at an operating level? Because that's where the cash that services our debt then filters from. So we're right behind all the other costs that need to be paid in the business. And so unit economics then becomes a really, really key factor for us. And having that visibility, and I think that's all then tied into everything that I've sort of spoken about before, about the product, about the team that's there, about the capitalization. Because to do that, there's a bit of scale that the business needs to achieve as well, beyond which any additional amount of revenue or unit produced then falls down into the cash waterfall to service your debt. So those are sort of things we look at, but I think what's really important is the product and the management. And I think if you get those two things right, and you can manage your supply chain before you get to the business, with financing and getting to the customer, then it's half the battle won for us. Yeah. And then what we then look at after that is the other things that are, in my view, secondary. But that's really what we look at as Africa Go Green.
Mm-hmm. Thank you. And how to link that back to the unit economics itself. So how critical is that in the assessment for potential borrowers in the clean cooking space?
So for us, it's particularly important because if our experience, and I'm sure different investors and different companies have different experiences, is the clean cooking businesses are what would be called businesses with high degrees of operating leverage, right? Where they have a high fixed cost base to set up the business, to set up a distribution network, to be able to have the infrastructure they need to produce and to make sure the product gets to the client. Now, for us, if a business, we believe a business has to produce a minimum amount to break even, right? So to cover its costs and for the project to wash its face, beyond which then any additional amount of product that is sold into the market is marginal. But that happens within a limit, right? So it's all about understanding what additional capacity is there in the business before it gets to its break-even point and before it needs additional investment in its infrastructure, be it manufacturing facilities or the distribution network or anything, before we need to invest more capital. Now, if that headroom is there, then it makes the job easier for us because that's what we're going to invest in. So that's sort of part number one. I think also when you look at it, sort of take a segue a little bit, because I've concentrated on businesses that are generating cook stoves or upselling into the customer. You also look at guys that are doing the carbon projects, for instance, right? Who's a key part of this because they're driven by the cook stoves. We need to also understand, because we know the carbon revenue is being used to subsidize part of the cost to get the cook stoves into the market. And it's about understanding how much of the expected carbon revenue is being used to subsidize the cook stove up front, and how much is left for me as a lender to be able to get my money serviced. This is in addition to potentially 18 to 24 months of no cash being generated by the carbon projects because they need to distribute the stoves, and it's 18 months until you get your first amount of cash flow. So unit economics, in our view, as Africa Go Green, is critically important. And I think as the businesses grow, your unit costs should be coming down if you're within, a certain parameter, and that should allow access to financing. And we're being very innovative in Africa Go Green around how we look at this. The inclusion of carbon revenue in the unit price today, because do you look at it on a present value basis on a per unit? How do you determine that? And how secure is the carbon revenue going forward? And we're factoring all of that into our thinking of the units and how we then do the financing. And hopefully we play our part in pushing the agenda of clean cooking and having the impact we're hoping to have.
Mm-hmm. Yeah, thank you. And how important is carbon financing for you with the prospect when making a funding decision?
Well, it's not the be-all and end-all. It is good in that it improves the profitability and gives the lender some comfort of, determinability of cash flow into the future, right? So when we look at it, like I said, a couple of things we look at is the team, right? You need to make sure that you're backing the right team, that these are people that can go to bat for you as a lender. Because remember, as a lender, you're not sitting on the board. So you need to be confident these are guys that can go to bat for you if things go wrong. I think, and then the importance of carbon is that extra cash flow, that extra buffer. We're also starting to take carbon as security, which is something that a lot of people have not been doing. So if you have a project that is registered and there's sort of an offtake, I liken it to project finance, for instance. That's starting to unlock funding for businesses. So carbon is important to the extent that it is structured properly, to the extent that it is contributing towards the overall profitability of the business. But it's not the only thing we look at, because the clean cooking space, there are businesses that aren't looking at carbon right now, but they need to be funded as well, right? So it's an add-on, but it's not the be-all and end-all. And we hope that as the market grows, as the sector grows, carbon, as carbon becomes more and more key and prevalent, we continue to support clean cooking, but also carbon projects that are linked to clean cooking.
Thank you. So we're always coming back to carbon finance in many ways. I would like to open the floor now to questions from the audience. And I will take 2 questions at the same time. And I would also like to ask you to briefly introduce you so our panelists know who you are and everyone else. So please go ahead. Yes, please. I think a microphone should be coming somewhere. It is coming. So I promised I'll leave a bit more time for questions this session than before. So,
my name is Faith Chege. I'm with EP Africa. We are illicit investors like ACF with just smaller ticket sizes. My question goes to Farai. I just wanted to know, I saw on your website that you have a TA facility as well. Mm-hmm. What does that entail? And also, what are your ticket sizes?
Thank you. And one more question in this round.
Hello. Hey, I'm Govind Agrawal from Anaxi Digital Runners from India. We are pitching for Tech for Climate, providing tools for monitoring last mile execution of projects. My question is related to beneficiary identification. It's like in cookstove projects, usually if you see how these standards go, they ask you to do a baseline survey. It could be like 10%, 20% or 30% max what people do. What we feel is like, what our experience is that, if you want to give away 30,000 cook stoves in a particular geography, you need to go and meet maybe 45,000 plus people, have the complete data of those individual households and the family, so that you can identify 30,000 useful or eligible audience. But that is not the approach which I am looking at. It's like last 2 days being here. So is that something I'm missing, or like how important is beneficiary identification?
Is this question directed to someone specific at the panel, or you would?
Maybe in general.
Okay,
yeah.
Thank you so much. Maybe start with Farai, and then whoever wants to pick the second question.
Sure. Okay. So our technical assistance facility is available on a non-reimbursable grant basis, subject to a 20% contribution by the beneficiaries. That is to say, we fund up to 80% of eligible cost. What we use it for, like I said, we're operating in a very nascent space, which is greenhouse gas emission reduction and energy efficiency. So it could be anything from market development, market studies, capacity building, and transaction costs, because we also know some of the borrowers we might work with might find doing diligence quite pricey. And so we're able to provide some of that technical assistance to help the deals get over the line. In terms of ticket size, we do technical assistance up to an amount of about 300,000 per beneficiary. And there are then different conditions in terms of procurement. So the conditions differ for a 50,000 grant as they will differ for something that is 300,000. I hope that answers your question. So we typically, and I've been asked this question while I've been here, and I keep getting told that's probably too big for what the sector is, as Hiroshi is nodding. But we typically try to look at anything from $2 million going up. If there is a path to going beyond $2 million within 12, 18 months, we can go below the $2 million. Yeah.
Okay, thank you. Roger, would you want to comment on that? Because we're like at gate.
So I had a comment in the previous panel about the ticket sizes, and I fear that we are making the same mistakes as always, right? No matter what type of finance, innovative finance we invent, RBF, carbon, climate bonds, whatever. If the minimum ticket size is not something that we start talking about now, we will never get there. Why is that? Because you just look around, there's lots of people doing distribution of stoves or LPG or EPCs or clean cooking technologies, and we're all over the place. Small countries, big countries, small companies, big companies, and then, let's learn from the solar sector where I think there are 3 companies left. International companies based in, I don't know where, US probably, and they just taken over and they gone like whoops, and the whole sub-Saharan African solar space is being dominated by 3 players, and those 3 players get 70% of the money. Are we going to make the same mistake in the cooking sector? And one of the bottlenecks, and I agree completely, and I know what the due diligence is that the ticket sizes are way too big for most of us. And I don't have the solution, and I don't know how to solve this problem, either RBF or carbon or this or that or whatever, right? And consolidating, as Ada was saying.
Yeah. Can I come in quickly?
Of course.
I think as AECF, we are totally identifying this missing middle ticket size. We are reflecting on it and thinking what is our role as well as a catalytic investor. Shall we start also matching this ticket size, which is bigger than what we do, also looking at different type of financial products. But I think even if when we venture into it, we'll find it very hard to raise capital to invest in that missing middle. And yeah, I just can't wait to hear of an investor that is doing something different, that is targeting and really tackling this missing middle. I've come across quite a few crowdfunding platforms that are trying to design campaigns to meet this kind of ticket sizes, but then is it fair to put the credit risk on the crowd?
True.
I don't know.
Good point. Maybe lowering transaction costs, but yeah, that's another side. I think we had a second question. Have we lost the thread, or do we need to repeat that second question?
I can comment on the data side, but I'm not involved in any credit, carbon credit or anything. So we are a very data-driven company because it's the way to do business, right? But not because of somebody else coming and checking, is this client the client that you said is your client? Mm-hmm. I'm a distributor, so I know my clients, but I don't know what that means for the rest of the world.
Anyone else wants to comment? So, sorry if that doesn't fully respond to your question, but maybe one of the other sessions might be able to touch on this important issue. 2 more questions. Shweta. And do we have a mic? 1 second.
So my name is Shweta and I work at the Shell Foundation. We're grant-based investors. I love the idea of the way you framed it in terms of impact premium and impact risk. And I think this is a really important point because I think we need to sort of recognize who are the players in the market who can scale in terms of taking this impact, risk, and premium. From your perspective, who do you think are, like, from the sort of universe of donors, governments, like, how do we actually get more people? Because I don't know if commercial investors are going to have the large appetite to be able to take that specific risk or a premium attached to it. But I'm just trying to understand, like, I think that's a really important layer to it, ensure that this sector starts to become investable from a unit economic standpoint. So what are your thoughts on that?
Thank you, Shweta. Is that a specific question for someone or?
That's
Okay. And I take a second one, please, over there.
Thank you. My name is Patrice Binois. I work for UNCDF. I'm a business support specialist in DRC from Congo. I will talk about that impact premium and impact risk, especially for francophone countries like in Africa. What I've realized is that almost all the effort, all the money is going to some countries in Africa, like let's say Kenya, Nigeria, Ghana, somehow Rwanda, this early days, but all the Africa, like francophone countries are left behind. And I don't know why investors are not interested in those kind of country, especially like my own, Congo. Congo is like, how do you, I call it, I say it in French, c'est le poumon. Hein? C'est le poumon de la terre pour l'instant. Mais there is only few investments going there to support all the efforts. Thank you to UNCDF and what we are doing, like, yes, and trying to bring more capital and more investment. Like, I have some questions from companies that I've applied to UNCDF, RFI, and facilities, but they were not, somehow they were not selected or they were not eligible. But they say the money you are giving even is too small. That is what they are saying. The money you are giving is too small. And the other one, they say, why didn't you choose us? But when I see that the minimum like investment you say is 2 million, that 2 million is enough to fund a lot of small units in Francophone Africa, just to help them start something or to do something. So my question is somehow general, but I would like to get some feedback from investors. Thank you.
Thank you. That's a very interesting question that taps right into that issue. Where do you allocate the funds? Early stage, mid stage, large stage? But first, to start with Shweta's question, on impact premium and risks.
So who
I
should
think it was for Rotjo? Yeah.
Who should be taking the impact risk and who should be paying the impact premium? Is that your question? Oh, well, yeah. Well, I like, you know, theory of risk. Who should be taking the risk? The people that can afford it, right?
I'm saying because it's impact and it's an important sort of element of making such businesses viable. I imagine the role is more people who care about impact significantly more, so the donor community and the government. So I'm just trying to understand from your lens, what is that universe that can take on this impact risk significantly from a scale point of view, so that we are able to sort of...
I don't know, right? I'm not an investor, right? Only indirectly, but our experience in terms of working with others on the impact side, the positive experiences we have had are mostly foundations and family offices. Those are the people that really care about the impact, and they understand the end result, right? What they are looking for. and they are the better suited people to take the risk of failure, right? Because at the end of the day, we're doing something quite risky. But I'm not an expert on the landscape of investors, because all of us call ourselves impact investors, but there are so many flavors that, your money is coming from DFIs probably, right? You can't put, the Dutch government next to a nice foundation in Indonesia, right? It's not the same. So I don't know.
Yeah, maybe to complement, I think what we are seeing is that there is a big tension now in the impact space between quantity and depth of impact, and a big push from at least bilateral donors and governments to have big numbers out of their impact investments into companies. And we are here to kind of have the voice of saying, if you want to invest in difficult frontier markets like Somalia, South Sudan, Mali, where we've been investing for 8-10 years, into local companies, you'll have a lot, your impact will look much deeper, but in terms of numbers, it will never compare to investing in a solar home system company in Kenya. So where do you put your priorities? And these have also deeper impact, but also other externalities. They impact on income generation, value creation, building resilience, contributing to peace, and this is not priced, but it has a huge value. So how do you also valorize as an impact investor the non-monetary impacts that you're making from investing in energy access or in clean cooking in difficult markets? But I find that donors, bilateral donors or government DFIs, are becoming more and more risk averse. They really want low-hanging fruit and quick wins, and it's becoming more and more difficult to do depth and to be acting as what we are, which are market builders in very difficult segments where no commercial investors is going, to get them comfortable coming. You need to take risk, you need to invest a lot of money for building trust and getting these first dollars into countries where no investments have been flowing.
Yeah, Vincent.
Yes, I mean, I agree very much with what you just said. I think there is still a lot of need for effectively subsidy or grant financing in this sector. I think in the session before we had some very interesting thoughts about how we can also monetize this broader impact that we're looking for, whether it be forest conservation, like nature-based solution, nature assets sort of thing, or how we monetize how health benefits, for example, can save countries X amount of dollars on a health budget or something like that because they're using clean cook stoves. So how we can make these links, I think, are very interesting areas to look at. But also one thing, and that touches a bit on Patrice's point, we really need to see how we also galvanize national, local financial sectors in solving these finance problems. We're often talking about very fancy financial solutions, and typically, entities from the north come in and sort of, yeah, this is what we can all do. But in fact, there's a lot of capital in countries which is not really targeting this sector very effectively at all, and where we believe there's probably a lot that can still be done. So local banks, financial institutions that can really be activated and provide, for example, local currency loans, which are much more interesting than dollar-denominated funding or what have you. So I think that angle and how we not repeat, in a sense, the off-grid solar experience too much in terms of relying on a few funders, few companies to get the outreach. If you look at 2.4, 2.8 billion clients, even if you have 1,000 companies delivering millions of energy solutions quickly, I mean, think about it. We're not there yet. So we need a step change investment mentality in the sector. Over.
Very quick, briefly, yeah.
I'm going to try and address in the perspective of Africa Go Green. So in respect of Francophone Africa. So we actually prioritize West Africa. I think if you've been on our website, you know that we have a significant portion of our capital that should go to West Africa. We've already invested in Burkina Faso, Togo, Cameroon, or Cameroon is central, but it's Francophone, Chad, and Senegal as a fund. And Ghana is actually a priority country for us. So it's just a matter of identifying the right opportunities for us. And we have people that have been on the ground talking to different companies in these areas. Now, one thing I want to say about the ticket sizes, we've realized this challenge that's there of ticket sizes being sort of 2 million, for us at least. And what we've decided to do is to work with local financial institutions where we can and provide them funding so that they can funnel that money to the lower ticket size opportunities. Now, typically that takes time to get that going, but it's something we're working on as Africa Go Green to try and channel some of that financing we have to be accessible to the smaller businesses. So certainly West Africa is a focus for us. We are trying to work around it by working with intermediated credit, giving financial institutions, and we're also, just for reference, able to provide funding in local currency at the 2 million level or for local financial institutions to on-lend. And so I wanted to say.
Thank you, Farai. I think there will be a whole session on Francophone countries tomorrow where there's more sufficient time to discuss this important issue. So I'm just looking at Lindsay. Lindsay, do we have time for one more question? Yes, we have time for one more question, so that needs to be a good one, please. Who would like? Yes. Yes.
Thank you. Hello, my name is Hannah. I'm from Sierra Leone. We manufacture cook stoves. It's just a comment or more an observation with the local banks. So one of the problems we face is very high interest rates. So when you say, for example, you want to lend us money and you work with a local bank, would you consider the interest rates that the banks would give us?
Thank you.
Thank you.
Yes, we would typically do that, but I think the one thing that's important to remember here is commercial banks locally operate within confines of the regulations of their reserve banks, right? So that's one thing to also take into account in considering the capital structure and how they need to price things. But we would typically look to say this specific pot of funding is for this specific sector, and you can make a margin of X over the funding that we are providing, right? But then there's always the caveat of what are then the local regulations in terms of how they have to price it. So we have looked into it and would like to do that, but there are limits to what we can do.
Thank you, Vincent.
Yeah, and one other thing I think is interesting to explore is like some guarantee structures where you can reduce, for example, collateral requirements that companies often have to cough up huge collateral to take loans. And if the donors can do more to have this first loss sort of investment mentality, I think then it's easier to bring down these collateral requirement costs, and then that translates into accessibility for energy service companies. Over.
Yeah, I just wanted to add, so we also see by working like that through FIs in Somalia that it can also very much help. We capitalize them, but also with a first loss guarantee. Plus, working with them on kind of rewarding where they will invest and what kind of impact, to also help them better understand the impact that their money is releasing and enabling on the market, and to reward them for investing into more impactful businesses, working with them on lowering and decreasing their risk and therefore the interest rate that they put out there. However, it's also complicated for a local bank to be giving different interest rates depending on the sector of the client. So, they can't shoot themselves in the foot with their own client, and also it depends on the liquidity in terms of the local market. So they have very big constraints often that our intervention alone cannot fix. which is why we also work with usually the central banks and ministries and look at more macro level issues as well.
Thank you. I think we mentioned that, it came up in the previous sessions that it is a lot of education that needs to be done on this space. Yes, sorry for being a bit pushy here as we're slightly running over time. I'm happy that we deep dived in quite some areas in the unit economics, but it's such a wide field, so a lot of other issues are untouched. I thank you so much, our panelists, for your contributions. Thanks, Lindsay, for the wonderful organization of the session, and Ed for the presentation, and all of you for being patient and cutting off a bit of your lunch break. Thank you so much.
Thank you, Susanna.
Thanks, everyone. We actually did not cut off your lunch break. I want to do a little bit of an announcement on time. So, in fact, we distracted you while you might have been waiting in a hungry line of people outside. So, just a quick update on time so everybody's on the same page about gathering back. The plan is that the next session will start at 1:45 p.m. So lunch will be starting to get served in 10 minutes at 12:30. So lunch from 12:30 to 1:45. And then the next session after that will start at 3 p.m. with a quick coffee break in between. So lunch starts in 10 minutes at 12:30. Please wrap up and be in the rooms by 1:45. And then we'll do the next session at 3 p.m. because then we'll need to convert the rooms for when we do the final plenaries today. So thank you for joining us in the finance room. We'll be back in action at 1:45. Enjoy your lunch.